works with us. But basically, our approach is, what I would offer to all of you is, we're here to serve as a resource for you. We're more than willing to answer questions. We don't, charge for walking folks through transactions. The way that we can serve really as a value add for your business as realtors is to serve as that resource for you. And there's no obligation, but after this Zoom meeting, I would encourage you, anytime you all have questions, to feel free to reach out. So my objective today is go through these resources that I sent to you. One, there's the reference guide that I have on the left side of my screen that talks about the basic rules that we'll go through, in addition to the important cooperation Section 1031 language that you should have in your purchase agreements down at the bottom here. We'll go through that. We're going to go through some red flags. We're going to just do a real flyover of everything. And we're not going to get into, the nuts and bolts in great detail, other than to equip you with some information and, as appropriate, some tools in your toolbox to work with your clients. And certainly, when I teach realtors, invariably, half of the folks in the class have their own investment real estate, and they understand exchanges, and they're not just doing it for their brokerage business, but also for their individual investments as well. So it's, Section 1031 is an amazing tool, not just for your brokerage business, but for you individually, in terms of, building equity and, using the government's tax dollars and having the present value of those tax dollars to increase your holdings. So we'll go through the red flags. And then the other thing I wanted to mention too, which I'll talk briefly about at the end, is, whenever there is a change in administration, and obviously I'm not making any predictions, but I would say that I'm heavily involved with the Federation of Exchange Combinators, which is the national trade organization for the 1031 combinator industry. I'm co-chair of the Government Affairs Committee. And so I'm extremely active in Section 1031 lobbying and legislation and potential impact of federal legislative changes to Section 1031. And there has been some discussion within the Biden campaign about eliminating Section 1031, which would be a major blow to real estate transactions. And I think certainly those of you on the call who understand exchanges, and especially in the context of commercial and farm and investment properties, it would be pretty dramatic. So this resource here is for you to take a look at, and to the extent that you have opportunities to connect with opinion leaders, your members of Congress, that's a resource for you to look at. And then also there's a 1031 taxreform.com, which it looks like we need to put on here, but we will, that's a resource for you to look at as well. So anyway, we're going to get started here. One of the things with these Zoom classes is we do a lot of, I do a lot of teaching, and this is unique. It's challenging. And I'm not entirely certain how it will go, other than, whenever it's interactive, it makes it more engaging for everybody. And I would strongly encourage you to ask questions or type your questions. If there's something you'd like to have more information on, during or after, we can connect. So let's get started. So, when you're talking about a Section 1031 exchange, you can't talk about it before you talk about the other options as well. So you, as brokers and folks who understand real estate, there's several different things you can do with an asset. You can hold it, you can cash out. There are opportunities and reasons to do an installment sale. Looks like somebody's requesting remote control of my screen. I'm going to decline that. Okay. So an installment sale is an option that can work, and then also there's the 1031 exchange. So, getting into the reasons to hold, there are reasons that you would not want to sell. If you have a strong asset, that you are making, significant cash flow, or you have, significant future appreciation, there may be reasons to just hold it for whatever reason. Oftentimes, folks just don't want to pay the tax, and that would be a reason to hold on to an asset. And then for estate planning purposes, one of the questions that we get, if somebody is older and they're saying, should I do a 1031 exchange or should I cash out of the asset? Under Section 1031, presently, and this is being targeted by, it could be an issue in tax reform, future tax reform, but whenever heirs inherit an asset, they receive a stepped up basis in the property. So as an example, if somebody owns inherits a $500,000 100-acre farm, 120-acre farm, and mom and dad, they purchased the property for $100,000 in the 80s, and it's appreciated $400,000 to the $500,000 value. If that property is passed on to the heirs, then the heirs received a stepped up basis. So while mom and dad's basis was $100,000 in the property, at the time that it's inherited, that basis goes from $100,000 to $500,000. And so if somebody's in a position of selling and mom and dad are saying, gosh, should we just take the cash or not? It makes a significant amount of sense from an estate planning perspective to exchange so that you're not taking that big tax hit and then it's inherited at the stepped up basis. So that would be a reason to hold on to a property. Reasons to cash out, certainly debt reduction, can be a big factor, especially with the struggling farm economy. We've seen a lot of situations where folks are looking to cash out to restructure. Back in 2012, when the Bush tax cuts sunset, we saw a significant sale volume increase because we had the prospect of higher capital gains tax rates going into play, which they did. So folks were looking to cash out in advance of that potential situation. Under the Biden administration, there are proposals to raise capital gains tax rates to ordinary income tax rates. So that would be a reason to potentially cash out this year or next year. And, when you think about what, the time horizon is of tax, changes, I think with the economic uncertainty and difficulties and the potential drag on growth that increasing tax rates would potentially have, if there are changes to the tax code, assuming there's a Democratic administration, we're probably looking at a runway over several years, to see what happens, but it's just something to keep an eye on, that there may be reasons at this point in time to cash out to take advantage of lower capital gains tax rates. Diversification into different asset classes. If somebody owns a bare piece of ground on a commercial intersection that's not producing cash flow and is a significant, property tax drain, there might be a reason to go into a cash flow asset. Some folks might want to go from multifamily real estate into a farm to have less management intensive situation for them. So you can go from different types of real estate into other different types of real estate, which we'll get into. And then there are reasons that somebody would start a Section 1031 exchange and say, gosh, we can't find something that we like, but so we're just going to start it and then cash out. And certainly you don't want to pay up for an asset just to avoid the capital gains tax. And one strategy is to start the exchange, see if you can identify replacement property within 45 days, And if somebody can't find the property that they want, then they can just cash out, receive the funds back on day 46, and life goes on. So, you know, there are certainly benefits to beginning it. Now, let's talk about installment sales. Installment sales can be really beneficial because if we were to sell out of this asset here, $1 million sale, and the basis of the property and the basis, and this is probably, you know, everybody knows this, but that's really the cost. That's the tax cost of the property. So if I paid $200,000 for the property in 1988 because I put those investment dollars in, I do not have to pay the capital gains tax on that $200,000 basis. And then anything that we sell the property for over our basis of $200,000 is our gain. And in this case, we have an $800,000 gain. And I'll talk a little bit about tax rates as I go into the upcoming slides, but if somebody were to cash out of this $800,000 gain today, I think you could safely assume you'd have roughly a third. You'd pay roughly a third in tax. So, you know, $240,000 of tax in this situation. And by stretching out payments over a number of years, you can reduce the tax rate paid because you would be in a lower bracket due to the progressivity of the capital gains tax rates. So, you know, in this example, if there's a $200,000 receipt each year and we have that $160,000 that tax, it would be taxed at a lower rate. So instead of paying $240,000 of tax, in this instance, it would be $140,000. So there are different types of, there are different scenarios where that would be an appropriate you know, tool to use to reduce capital gains tax rates. Okay, so this is usually when I'm in a live class where I ask if anybody has questions. So you're, again, more than welcome to send something over if you have something, and I think Christy will dive in if we do. So we've gone through holding the asset, installment sale, cashing out, and then, you know, certainly the Section 1031 exchange, which is why we're here today. So any property that's held for investment or used in a trade or business qualifies. And that's any real property. So we'll talk about the different types of properties that work as we move forward. But all the proceeds from the sale of the old property can be utilized to purchase the new property. And, you know, one question we often get is, do you have to reinvest all the money, or do you have to, you know, buy as much or more than what you sell for to defer all your tax? And the answer is yes, to defer all your tax. But there are situations where somebody might want to not reinvest the full amount. And you can do a partially deferred exchange if you don't reinvest all those dollars. That's fine. You just pay tax to the extent you don't reinvest all the funds. And there's some nuances and tricks and things like that that you have to consider when you're cashing out, which, you know, if we have time, we'll get into here at the end. But, you know, really the beauty of 1031 is it's an interest-free loan from the government. So that $240,000 that you would have had to pay in our previous example, instead of paying that to the government, you get to retain all that equity, and you get to you know, use those dollars towards your business and investment activities. Section 1031 is not a tax avoidance mechanism, okay? It is a tax deferral tool. If somebody sells their house, you all, I'm sure, know that you can exclude up to $250,000 of gain for an individual and up to $500,000 for a couple, and that money you get to put in your pocket. There's, you know, you can do that every 2 years, in fact. So it's not, it's a pure incentive and benefit to, you know, property, to household residential owners, where 1031 is just a deferral. So if somebody eventually cashes out at some point in the life of the investment, they'll pay the tax. And interestingly, one of the arguments about Section 1031 is that it's a defer, and then die. So, you know, the knock on it is, you know, people use it to, you know, really avoid tax for the life of the investment. And we've had several studies that we've commissioned as part of our government affairs work who have said that that's not the case, that in fact, 88% of all exchanged assets are disposed of at some point during the life of the investment. So people do use it as a present value tool versus just a defer, die. So that's a bit of a myth. And again, depending on what happens with, the next administration, potentially removing that stepped up basis could, create a different scenario for folks.
Okay, Dave, we have a few questions.
Yes, let's do it.
Okay, the first one is, so how did they keep paying the same tax amount every year? You said something about sending receipt to somewhere all the time.
Okay, well, I'm not, so that was just an example, I think, of the installment sale. And I'm not, this depends a little bit on how much income somebody has as well. Just, this is just a simple example of showing sort of a static situation. But if somebody makes, over $400,000 in income, that rate's going to go up. So all these different tax rates can be impacted depending on other earnings and different sources. So this is just a simple example of showing that by breaking out a sale, we can minimize the tax rate, but it just depends on the individual circumstances.
Okay. The next one is, can an owner offer owner financing and still use a 1031?
Okay, so in other words, can you sell a property on contract to a buyer? I think that's the question. So the example would be, I have a property that I am going to sell to, let's just say it's a duplex that I'm going to sell to somebody for $250,000. And I'm going to take $50,000 down today, and I'm going to take a $200,000 carryback note. So the question is, can that property be exchanged? And the answer is yes and no. So a contract for deed or an installment sale is considered a disposition at the time that the property is, or that contract for deed is recorded. So instead of, a deed being the conveyance document, the contract for deed is the conveyance document. It's just seller financed. So under Section 1031, only this gets really in the weeds a little bit, but all the exchange funds or all the consideration of the sale has to go to a qualified intermediary. So in that case, we would receive the $50,000 down payment into the exchange account. And there is a mechanism to take and convert the $200,000 carryback note into an exchangeable interest, but that requires a payment to us as the QI, and then a substitution of cash for that carryback note once the replacement property is acquired. And it's impossible for me to, adequately explain that in like 1 minute, but that's a long way of saying there are significant hurdles in that scenario, but there can be solutions. And that would be a situation of where, if somebody reached out to us, we could walk them through that process.
Okay, the next question is, I would appreciate clarification on the previous slide as well. How do they pay over multiple years?
So in an installment sale, basically, you would set, it's just that it's the contract for deed. So you're saying, I'm going to sell to you, buyer, but you're going to pay $200,000 down, and you're going to pay me $200,000 per year for the next 4 years. So it's a contract for deed. It's an installment sale situation. That's what we're referring to.
Okay. Can you find a new property and purchase contingent on the sale of your investment property? Can you eventually use a 1031 exchange property as a personal home?
Okay. So I'll address the first question. That the answer is yes. And in fact, there's some exceptional tools and ways to work with the exchange deadlines, and I'll talk a little bit about that now. But we have so the important part of it is that the 1031 deadlines begin at the date of closing. It's not the date that somebody enters into a purchase agreement. So if somebody said, "Gosh, there's this Florida condo that's perfect, and I want to sell a farm in Nebraska and go into this Florida condo, but I'm going to set my Florida condo closing for March 1." And that gives me between, today, October to March 1 to get my relinquished property closed. That absolutely works. So if you can set the closing date of your replacement property to occur after to give you some time to sell your relinquished property, that's an option. You could make the condo purchase contingent upon the ability to sell the relinquished property farm in a 1031 exchange. More commonly, what we see are auctions where somebody says, "Okay, neighbor, I will sell you this 80 acres that adjoins, your property if I can buy this 160 acre property coming up at auction in a month. And if I can do that, and I buy this property, then our sale of the 80 acre, that contract will become binding. But if I'm not the successful bidder on that 160 in a month, then our agreement to sell the 80 is null and void." So there are lots of different tools to manage the closing dates and purchase agreements that way. So another great question. And then I do have some other slides talking about conversion to a personal residence. And the answer is that can occur. So if we take my 80 acre farm, or again, maybe it's a duplex or it's a fourplex, it doesn't matter. Somebody could go into the Arizona condo as long as it is rented for at least 14 days per year and it's used for less than 14 days per year for the 2 years after the exchange. There's an IRS ruling that allows for the conversion of that property into a personal use asset. And then somebody's next question is, can I avoid the tax if I were to sell that as a personal residence after having owned it for 2 years? And folks were doing that, I think before 2008 fairly frequently, but they put some restrictions on that where, after 5 years of having owned an asset and having resided in it for at least 2 years, there's a pro rata formula that allows somebody to exclude a portion of the gain as their personal residence, and that increases each year depending on how much they've used it. So, all right, how about if I move? Go ahead.
We have another one. I don't know if you can answer this or not. Any recommendations of who we could talk to in order to facilitate an installment sale in Lincoln?
That's an attorney question. So work with your attorneys who can set up an installment sale.
Okay. Can a bank be involved in an installment sale?
Okay. I don't know. I haven't heard of that. I suspect that there are different structures of having companies come in and buy out a property and sell it to a buyer on a structured or an installment sale, allowing the seller to have cash. It's sort of a complicated question, but something that could be explored. I've never heard of a bank doing that though.
Okay, that's my last one for now.
Okay, good stuff. Great questions. Thank you. All right, so and that's the key to this session, is making it valuable to you. So keep them coming. Now, 1031, consolidate or diversify. So these are different reasons to do it. So maybe there's multiple properties around the country where folks want to get closer to home, or instead of having properties in different areas of town, they want to go into one larger asset. Increasing cash flow by changing investment type. So 1031 Investment properties don't necessarily need to be cash flow assets. Any property held for investment works or held for appreciation. So timber that's held for appreciation, that's a qualifying property. The same would be a bare lot. But maybe somebody wants to go from that non-cash flow asset into a cash flow asset, a triple net lease, convenience store, or a farm or something like that. Relocating investment property, we can go anywhere in the U.S. to anywhere else in the U.S. We cannot bring foreign property into the U.S. and we cannot exchange U.S. property into foreign property. So it is, one of the benefits of 1031 economically and from a policy perspective is that it keeps dollars onshore. We talked a little bit about stepped up basis already. Reducing managerial burdens. If folks are tired of managing, single family rentals and they want to go into a triple net leased asset or a farm, that would be an opportunity. And then eliminating capital gains tax. This is a pretty rare example, but it's just the one I just talked about, where if somebody converts an investment property into a personal residence, after a period of time, they can avoid those capital gains taxes altogether. I'll go through a few more slides and we'll take some more questions. Capital gains tax rates, 15% up to 200,000. You can read these, of course, but we have the net investment income tax at 3.8%. There are some phase outs of itemized deductions that can bump that up to 5%. So we can be up to 25% federal. Gain due to depreciation. So anybody depreciates an asset, that's taxed at a higher rate, depending on the type of asset. A Nebraska capital gains, that is a progressive tax rate structure up to 6.84%. And then if somebody were to sell a property and have a big sale, 3 months later, that's going to be taxed at ordinary income tax rates. So just for long-term capital gains tax in Nebraska, your potential tax rate is roughly 30%. That can go much higher if you've depreciated the property, because anytime you take depreciation deductions, oftentimes those are at ordinary income tax rates. So a commercial asset or something that's been cost segregated in the past can have, far north of 30%. It could be 40%, depending on income. And depending on the depreciation recapture. So 1031 is it's just an unbelievable tool. And again, there are times where you want to cash out. Not every situation is ripe for a 1031 exchange, and those are all worthy of exploring. But in this case, here's the real world effect. $300,000 of tax would be paid if we didn't have Section 1031. $700,000 would be available in this case, and that's real money. And even in the $100,000 example, if you had to pay $30,000 of tax, you only had $70,000 left over, there would be a strong disincentive to sell. And when we talk about potential for 1031 going away, we've taken studies from the commercial and farm brokers and anybody involved with investment real estate. They've estimated that anywhere from a third to half of those types of sales have a 1031 component, whether it's somebody's considering one or somebody's exchanging into the property. But the impact is that if somebody's faced with selling an asset and paying $300,000 of tax in this instance, or paying $30,000 of tax in a $100,000 example, that's going to be a tremendous drag on real estate transaction activity. Some of the surveys have said that you could assume transaction volume would go down by a third if 1031 went away for investment real property. And just think about your farmers. I mean, they have all this built-in gain into their property. They're not going to reposition their assets to bring a higher quality, property closer to home. It just would be a significant tax lock. So it's something to keep in mind. And then, here's the net benefit. This is a $100,000 gain. This is the time value that we're talking about with 1031 and why it makes a lot of sense. And this is, the smaller example of the net benefit over time. And then, as we get into larger numbers, you can see that if you do a 1031 exchange, the benefit is really to your portfolio, compounds each year. All right, I'll take a break. What do you have, Christy?
I have no questions other than thank you, Dave.
Okay. People are staying awake so far. And people think 1031 and tax, real law is this could be the really boring, but this is one of the most powerful tools available to brokers and to investment property owners. And understanding this is really can be significant in terms of building your business, building your investment holdings. All right, real property. The Tax Cuts and Jobs Act that was enacted in 2017 kept real property exchanges exactly the way they were before. There have been no statutory or regulatory definitions to changes to the definition of real property under 1031. Like-kind property is any property held for investment or used in a trade or business. Personal property exchanges were eliminated. So you used to be able to exchange tractors, combines, airplanes, locomotives, barges, any type of personal property, hotel, FF&E. That happened before the Tax Cuts and Jobs Act, but that was replaced with expensing of those assets. So, even though 1031 went away for personal property, if somebody were to sell a hotel and there was $100,000 of FF&E, furniture, fixtures, and equipment, as long as they went into a new hotel with $100,000 or more of FF&E, they could write off the new acquisition against that recapture that they had when they sold. One of the hiccups is if that happens in different tax years, you would have a taxable event. Let's say I sold a hotel in December 31st of 2020. And so I would have a $100,000 tax event in 2020, and then I bought my replacement property on January 4th, 2021. Well, I'd have to pay recapture on $100,000, and I wouldn't have a corresponding write-off until 2021. So cross-year exchanges of personal property can create problems. Something to be aware of. And then after 2023, there's a phase out of immediate expensing. It goes down by 20% each year. So you can only write off, 80%, 60%, 40, and then 20, and it goes away. So the thought was in 2023, Congress would have to act and do something different with personal property. So we'll see what happens. Now, so examples, bare ground could be exchanged for bare ground, 80 acres could be exchanged for an apartment building, retail center, vacation homes in limited circumstances, office buildings could be exchanged for a farm. And then, really this whole universe of properties can be exchanged for each other. So rentals for office, industrial for golf courses, any real property can be exchanged for any other real property. So if you've ever heard that you can only exchange a single family home for a single family home, that's not correct. That's 100% not correct. Any investment real property qualifies as being like kind to any other investment real property. Also,
I do have a quick question, Dave,
yeah,
if you don't mind.
yeah. No.
The question is there certain language in the if you're doing a 1031, is there certain languages that you need to use in the purchase agreement?
I'm gonna hold that question for now because
Okay.
I have a slide coming up on that will answer that question. But I do want to address tenant in common percentages, especially for families with siblings who own a third each of an asset, whether it's a farm, whether it's a strip center, or anything. Properties that have been inherited, if siblings have an undivided 1/3 common tenant in common interest, they can go separately into their own properties. Partnership interests become a problem. So if Joe, Tom, and Dave own JTD LLC, The LLC is the real property owner, and is the LLC has to do the 1031 exchange. So there are problems with partners going their own separate ways, but tenants in common can go their own separate way. If any of you are involved with the emergency watershed easement program for the Missouri River bottom ground that's being bought out, permanent conservation easements, if they are sold, can be exchanged into other assets. So if you come across that, that's something to think about. There's other partial interests. So the point being, it's not just, you don't have to own 100% of the property to be able to exchange into something else. There's varying types of interests that can qualify. So this gets into the question that you just asked, or somebody just asked. So somebody must have ESP. So purchase agreements, really important. So if you take away anything from this, first of all, they need to be assignable. One of the biggest hiccups we run into is if a purchase agreement says this contract may not be assigned to anybody, or you have to have the prior written consent or whatever. Assignability of the purchase agreement is important. Foreclosures, which, you know, hopefully we won't see more of those, but I suspect we might here over the next year or two. Anytime Fannie or Freddie or other you know, lenders take back properties, they have prohibitions on assignability, so you want to watch your purchase agreements there. And I'll go into the different options for cooperation language that we have on the next slide. And then I'm going to skip over a few of the other things in the interest of time. But if you take a look at this reference guide right here, so this is the front page, and then this is the back page at the bottom here. There's a paragraph that you can put in your purchase agreements that is, you know, that section 1031 language, which, you know, you can use an addendum. You can, you know, drop this paragraph directly into the purchase agreement. Make sure your purchase agreement is assignable to a qualified intermediary that's required in order to do the exchange transaction. Here's some, you know, different issues with the hiccups that we see. One of the biggest misconceptions I think out there is that 1031 is a form-driven deal. Here's the forms, fill it out, you're good to go. I always say that if I went to work for the IRS and I did an audit of exchange transactions, I'll bet you I could disqualify half of them for not having been handled correctly, and potentially more. And that's because there are just, you know, different rules and requirements that don't get adhered to and are missed routinely. So, you know, this assignability and providing the notice of assignment and the documentation issues that's an important part of what we do. So here's the language that that's in that flyer that I mentioned to you. Somebody asked about optional contingency language. This is just an example at the bottom. You know, you can take a screenshot of this if you want. And I think Christy's recording this too. And you know, there's just very different degrees of language that you can utilize to adjust your purchase agreements. All right, I'll take you want to go, I see somebody with a camera. You want to take a picture of that? All right. Let's see, where was I? There, I think somebody wanted that. Okay, moving on. Qualified intermediary. Now, you know, this is how we handle this is how we make money, of course. That's why we do all this education. In order to do a 1031 exchange, if somebody is selling to another party and acquiring from another third party, you have to use a qualified intermediary to handle that transaction. If you go through this red flags sheet right here, oftentimes you'll have qualified intermediaries that are disqualified depending on how they're structured. So, you know, it's really important to work with somebody that is, you know, qualified and understands these. The QI cannot be your attorney, accountant, real estate broker, investment advisor. Family members cannot be qualified intermediaries. Sometimes in a reverse exchange, which I'll talk a little bit about, the reverse exchange, if somebody can't sell first, then they need to buy first. You can do what's called a reverse exchange. And that's where the replacement property is parked with an LLC that we set up. And then it gives them time to sell their relinquished property and transfer it back into that parked property. So a lot of times what folks try to do for the end around is they'll say, hey, mom and dad, can you buy this property and hold it for me until I'm able to sell my relinquished property, and then I'll buy that from you as my replacement property. That does not work. That's a disqualified transaction because family members are related parties. Something to keep in mind. Check for red flags, planning, assisting, your advisors. We get questions daily, multiple questions from attorneys, accountants, and real estate brokers saying, hey, here's my transaction, here's my scenario, what are the options? And we're happy to provide resources and walk folks through that. And then, the documentation component is critically important in addition to handling the funds. There's the exchange language and documents that, we put together. There's monitoring the deadlines, assuring compliance, and then critically investment and management of funds. So you're going to want to look at, are they separate accounts? Is there fidelity bond coverage? More importantly, is there errors and omissions coverage? And what's the level of errors and omissions coverage? We have one of the highest limits of errors and omissions of countries like ours in the country. And we've handled billions of dollars of exchanges. So, in terms of the safety of funds, that's locked in. It's really, the potential errors that can occur that you should, factor in. So enough on the QI stuff.
Okay, we have a quick question on the QIs, Dave.
Yeah.
Should the QI have to be in the same state as a transaction?
No, absolutely not. So, we handle these all over the country. 1031 rules are federally and within Iowa, Nebraska, and Minnesota, Illinois, Missouri. They're all they tie together. So there's no state-specific requirement. There's a few states with regulations, nothing in the Midwest. But and then the other thing I would say, which I don't want to leave without mentioning this, you cannot hold funds in escrow and set up the QI documents and account after the exchange closes. When you think about potential liability for you as brokers, if you're at a closing and your client or somebody says, hey, I want to do a 1031 exchange, your first question needs to be, have you reached out to a qualified intermediary? Are your documents in place? Is your account opened? If they say no, you need to stop the closing. And that can be painful, but if somebody says 1031 and you're not reasonably assured that they have set things up in advance, stop the closing, because once the closing occurs, you cannot do a 1031 exchange. And there are ways to, you could unwind the transaction and restore the parties to their original positions and start over, but that requires deeding the property back, returning funds, redoing loan documents, major hoopla. So at all costs, do not close on a transaction without having a qualified intermediary set up. Okay, I'm going to go through a few other quick rules that are on this on the reference guide, namely, the QI requirement. We have the identification rules on the back page of this reference guide right here. 45 days to identify from the date of closing. So if I sell the relinquished property tomorrow, I have 45 days to pick something out. I have 180 days to wrap up the entire transaction. Those two time periods run together. I'm going to skip over some of the identification stuff just because I want to get to a few other things. But weekends and holidays are included. If somebody is involved with an improvement exchange, we need to identify the improvements. There was a court case I was actually an expert on in a neighboring state where the improvements were not identified on the identification letter. That resulted in a failed 1031 exchange. So, like I said, when It's not just the forms, it's the process and everything that goes into filling in the forms that are important. There are several different rules. I'm going to focus on the 3 property rule when it comes to identifying, but basically this is where you list 1, 2, 3 properties, sign it, date it. That comes to us as the qualified intermediary. You know, we keep track of the deadlines, walk people through it, but usually you identify 3 properties within 45 days, and there's a couple other rules that if, you know, say somebody sold property for $500,000 and they wanted to identify 4 properties instead of 3, they could use the 200% rule, which says that you can identify twice the value of what you sold. So you double $500,000 to $1 million. If they have 4 properties worth $250,000 each, they could identify all 4 of those properties as long as they didn't go over twice the value of what they sold. I'm going to skip over the 95% rule because we've used it one time, but it is an option. 180 days from the date of closing to close on the sale. And you know, this is an important one for those of you who are beginning exchange transactions toward the end of the year after October 17. We have 180 days to wrap up the entire transaction or the due date of the exchanger's tax return. So if we close on the relinquished property sale on December 30, we would have until April 15 to wrap up the transaction, because the IRS wants you to report the exchange in the prior tax year. That can be extended if the tax return due date is extended. That's an option. And there's also some great tools with installment sales, where if somebody starts an exchange before the end of the year and they find replacement property or they look for it, but they receive their funds in the next tax year, you have the ability to report that potentially in the prior tax year or the next tax year on some 1031 rules.
Okay, Dave, we have a quick question.
Yes.
Okay, is there a specific protocol for using 1031 for a client who received money from an inherited house sale who decided to build a home that won't be done for 8 months?
Okay. You know, I've got 10 minutes, so I'm going to skip to I'm going to go to the reverse exchange, which is that's where the question comes in. So I mentioned previously, if somebody cannot sell their relinquished property and they need to close on that new property first, you can park the property with an exchange accommodation title holder, and that's what we do. So we set up reverse exchanges. You know, we would step in the shoes of the exchangers, the buyer. They would, you know, loan us the funds to buy it. And so if we took title to a replacement property asset, we could hold it for up to 180 days. Now, if somebody wants to construct improvements, this is the same tool, the same mechanism is as how that's accomplished. So if somebody sells a $500,000, you know, it could be a restaurant, okay, and they want to move that restaurant into new construction, but the lot that they're going to build it on is worth $100,000. Only real property that's complete prior to the time that it's acquired is considered real property. So the way that an improvement exchange, and it could be like a house, same thing, $500,000 house, we're going to go buy a $100,000 lot, build a $400,000 house, and exchange into the completed house. This parking mechanism allows us to acquire the $100,000 lot, use the $500,000 of exchange funds to construct the improvements by paying the builder as progress payments. And once the property is complete, we would sell that property from the parked entity to the taxpayer for $500,000, and they would have a fully qualifying exchange. So I think that's the question that was being asked. But the reverse and improvement exchange, especially the reverse exchange, is really, really, it's a great opportunity, especially, also if somebody's, if there's a replacement property, oftentimes the hardest part in exchange is finding a replacement property in 45 days. So if there's a property that, is in foreclosure, or it's a short sale and you need to act fast, and, you're acquiring it for $100,000 under market value, you could park that property with us and then take 180 days to sell the relinquished property. So the reverse exchange is more expensive. When our fee is $1,500 when somebody sells first and buys second, and then the reverse exchange can add $6,000 to $7,000 to the expense. And that's just all the ancillary charges, LLC, closing, transfer taxes, everything. So it's not just our fees, it's just a budget. But if somebody is in a position of being able to acquire a property at a tremendous discount, or that makes a lot of sense, it just can be an outstanding tool to make that happen.
Okay, thank you. The next one is the 180-day deadline. Time starts when the target property is identified, the contract is accepted, or when the original funding property closes.
The deadline begins on the date the relinquished property closes. So if I enter into a contract to sell the single family rental with a closing 30 days from now, the deadline, or the deadlines begin in 30 days. And I would also encourage you, if somebody's selling a property and you're concerned about, finding property within 45 days from, 30 days from now, you can extend the closing date of the sale to 60 or 90 days, or you can say, I have the option to extend, 2 times, by 30 days each, or you can set closing for March 1, but by providing you 30 days notice, I can accelerate the closing date up, if I find a replacement property. So there's ways to work those deadlines.
Okay. What type of fees are associated with a reverse exchange, and how long can money be parked?
So I talked a little bit about the fees already. Your budgets, for a reverse is, it just depends on a lot of factors, but $7,000 at a minimum and potentially more. And then that property can be parked with us for up to 180 days. Anything else?
I do have, somebody asked if we will give them your email address in case they have any questions.
Yeah, so our website is at the bottom right hand of the screen, and then all of the PDFs I sent to you have our contact information. We'd absolutely love to connect with all of you. We do a lot of work in Nebraska. Frankly, Iowa and Nebraska are our primary footprints, and that's where we focus our time and energy. But we would love to hear from you at any time.
Dave, would you care if I shared your PowerPoint with the people who are on this Zoom session?
I would. That would be fantastic. I'd be happy to share that.
Okay.
So
we have one more question. I'm so sorry.
No, you're fine.
What are your fees for a typical 1031 exchange of residential or multifamily property?
Okay, so we have a standard fee. When somebody sells, we charge $1,000 for the sale of the relinquished property, and then if and when they buy new property, we charge a second leg fee of $500 for a total of $1,500. So, if somebody wants to start an exchange and they're not sure they want to buy, the $1,000 is what's at risk, or that's the potential downside. Otherwise, new properties $500,000. If there are multiple properties, it's $500 each. So yeah, that's it. And then that includes everything: documents, handling funds, walking folks through the process, start to finish.
Okay. Next question is, just to clarify, for an installment sale, we should talk to a personal real estate attorney?
If you want to structure an installment sale, that's a legal contract that the attorney would need to, your your local attorney would set up.
Okay. Thank you. That's all I have.
All right, so I'll go through a checklist for you all, just to think about in an exchange. One, make sure the property, see if it's held for investment or use in a trade or business. If that's the case, you should mention it to your client that 1031 might be an option. And then, obviously say whether it's a candidate, suggest they reach out to a QI accountant or attorney with 1031 experience. Mention the deadlines, and then make sure closing does not occur before hiring the qualified intermediary, and then including your 1031 cooperation language. So that's just a quick 6-point checklist for you. If something comes back, you have these resources available to you. As I mentioned before, the way we built our business is serving as a resource to all of you. So you should feel absolutely free to call at any time. So I think I am 1 minute away from 11 o'clock. I am very grateful for the opportunity to connect with all of you. Christy, thank you for this and your time. And that's all I have, unless there's some other questions.
Any more questions? Everybody says thank you. Thank you. Thank you. It was an awesome class. So thank you, Dave. We appreciate it.
Yeah, well, thank
you.
you again. It's great to connect with all of you.
Yeah. Okay, thank you. Everybody have a good day.
All right.
Bye-bye.